Hello, Portfolio Builder members. I've unmuted everyone just so we can all say hi real quick. We've got Jerry, Henry, Kathy, a few new people, Monil, Rob, welcome. How you doing, buddy? Jerry, I didn't have time to rebuild your spreadsheet yesterday, but I'll try to get that done after today's webinar, okay?
I updated a lot of it.
Okay, cool. Well, I do want to shoot you a new one and transfer it all over just to make sure all the formula is working perfect. All right, guys, I'm going to go ahead and mute everybody and do a short presentation, and then we will go back to the open mic and do Q&A. To start off, I just want to cover the most recent news today. Then we'll jump into a review of our trade alert, talk about how to protect our capital in the case of declining stock market, and then we'll open it up for Q&A. And if anyone else out there wants to, let's see, we got to watch your live. Yep. Okay, so watch live. Wall Street leaders face off with the House hearing. And so leading up to this event, we had Jamie Dimon put out a letter to the shareholders basically saying we need to create some social nets. And I think really he's just trying to protect the big paydays that the bankers get. And so this is all going live right now. We also had Ray Dalio go on 60 Minutes talking about similar things. I don't know who Emily Flitter is, but it made it into the mainstream news. Not a great day for JP Morgan CFO Moraine Lake when asked to raise their hands if a woman or person of color is likely to succeed them. None of the big bank CEOs raised their hands. Okay, so we're getting a general theme of inequality in America. We have the rich getting super rich, and then we have everybody else just pretty much making the same money they've been making for the past few decades. And so we'll talk a little bit about some of the solutions that are being presented by the super rich and what their bias might be behind that. And I'll also look at some critics' views of the current policy and what their ideas are, and perhaps there's some problems with those as well. The European Central Bank is not going to change anything, so they still have slightly negative rates. So it's basically free to borrow money for banks in Europe as they continue to be cautious of a slowdown. And so the euro took a small tumble on this statement with the quote, "Whatever it takes." He will do whatever it takes to support their economy. Here's a look at the central bank assets of euro, and we can see the GDP, the gross domestic products, nice slow steady growth, but not in relation to the amount of assets they've added to the central bank. Okay, so this is starting to give you a picture that printing more and more and more money is having less and less effect of actually improving the real economy. Mohammed, I don't know how to pronounce his last name. He's a CNBC guy. I like to listen to him. He's a cheerleader for America and its stocks. And so you'll see, with each news source, they all have their own bias. They have their own advertisers. So they all have a pretty pointed view, or at least they take all the facts and usually come to the same conclusion, almost no matter what the data is. While perhaps inevitable, given the near exhaustion of the effectiveness of central banks' exceptional measures to stimulate the economy, the ECB President Mario Draghi is coming across as rather defensive, repeatedly having to refer back to his carefully crafted written remarks. Okay, on other news today, close look at the CPI. So the one thing that does seem to actually scare central banks into having tighter monetary policy is inflation, which has been hard to find for the last few years. But it does look like it's slowly coming into the picture. When you look at the rent inflation, that is hot at 3%. So meanwhile, real hourly earnings were slightly down, but this is also on the rise. And we're seeing big corporation after big corporation starting to raise their minimum wage. Also, oil has been continually going higher this year, which also puts pressures on inflation. So if you're following our TBT trade, this is all great news as it puts pressure for the banks to raise rates. Gambling nightmare, casino profits collapse in Atlantic City. This is a chart of just the general Vectors gaming ETF. And if we look at 2014, there was a crash in the casinos, and then 2015 became a pretty rough year for the stock market. So perhaps this is a good leading indicator for the stocks. Stockman to Dalio, it's the Fed stupid wealth distribution in modern America started to go in hell in a handbasket in 1987, which is to say the exact time in which Bubbles Alan Greenspan took over the Fed and discovered the printing press. Another person I like to listen to is Peter Schiff. They both love gold, so no matter what's happening, their end conclusion is to go buy a bunch of gold. So Ray Dalio has been on 60 Minutes recently saying that capitalism is broken and that we need to pump more money into the government to fuel education and healthcare, and that they should raise taxes on the rich. And so we can see the wealth gap continuing. He even goes to say that if we don't do something about this, there will be a revolution. So perhaps he's scared that the poor people are going to vote to take all his wealth away, which is probably a good concern for him. And if he is proactive to appease the lower and middle class, that this may help prevent that. And perhaps that's what Jamie Dimon is thinking as well, with the sort of lingo in his recent shareholder address. So of course, folks like Stockman and Peter Schiff are outraged by this. They believe the big problem is the Federal Reserve and these central banks who are simply inflating the monetary supply. And then that money's flowing into the banks and from there being loaned out to people who are credit worthy according to the banks. And so that's the way it's been for the past few decades. And perhaps there is a good critique that the money is just going straight into the stocks, real estate, and various bond markets, and it's not necessarily creeping its way down to help the general economy. But the counterpunch to that is if we go back to the 1700 to 1900 era, where we were on a gold standard, we have a different problem. We have problems creating enough money to represent the growing economy of each civilization, and then we start seeing the countries doing currency wars. So it was not uncommon for these different countries to basically make runs on each other's banks to try to run the bank out of gold and create panics. And so if you do study the history of money, it's an interesting story. I don't claim to have a solution. Certainly just a pure gold standard doesn't seem to make sense. But also printing trillions and trillions of dollars and handing it to banks with no interest doesn't seem to work very well either, unless you own a big company that's on the public stock market. Then it's a huge payday. In other news, Lyft is now trading down 30% from its post-IPO opening highs, and this is right before we have two other big tech giants coming to play, Uber and also Pinterest. So we'll see how their IPOs go after this one was such a letdown. Coming later today, we also have the most recent Fed minutes, and I expect that they will say no change. We're still being patient and waiting to see what happens. So, of course, if the Fed were to surprise in either direction, either becoming more dovish than they already are, that would be bullish for us in the stocks. But if they were starting to get worried about inflation and raising rates, then of course we would do the opposite and bet that probably stocks are headed down. Okay, so let's take a look now at the recent trade. So our product started publishing right here on 12/12, which you might have thought was a great buy the dip opportunity, but shortly after the SPY cratered another $30 and then had this almost unbelievable rally, pretty much nonstop up since I believe the day after Christmas, or the day, yeah. And so what has our strategy been able to do with this big move? Well, we lost a lot less than everyone else by writing the in the money covered call, which we're going to cover with today, which we've been doing for about a month now, being skeptical of this rally. And then what else happened? Well, we didn't make all the money that people did just buying and holding the SPY. So the effect is that we can protect our capital, we can reduce volatility, slow down any kind of bleeding in our portfolio, and make a very consistent, boring return 3 times a week, 52 weeks a year, 156 times per calendar year. So let's look at the recent trade and how it panned out for us. And I will throw out in our email, there's a link to Robinhood app. If you're not using Robinhood app, you're throwing easy money down the drain. These guys are big. They're valued at $5 billion, and they're coming after the big broker dealers of the world. They've successfully pulled in a huge amount of users in the millennial group by giving away free commissions and free trades. So every last part of our program, from option contract writing to assignment to buying and selling stocks, they pay for every commission cost. And there's no difference which brokerage you use these days. They are all getting filled through the same liquidity pools. What's also nice is that this app makes our trading strategy extremely easy and something you can do from your phone. And they federally insure up to $500,000 portfolio. Plus, you can get the cryptocurrencies also, which are on a tear this year and also part of our diamond level program. So I'll take a look at that. If you do use our link, we do receive some sort of commission or rather bonus from them. They're giving you and our company a free stock. Let's check it out. I know everybody likes their broker dealers, so no problem if you want to stay where you're at, but you might be throwing away some easy money. So let's look at the trade we most recently did. This is the covered call we opened on Monday, and this is the covered call we closed today. And then below here is the new covered call we wrote, which expires Friday. And so this is a very repetitive process that we're going to be doing Monday, Wednesday, Friday, over and over and over again. So let's talk about how it works and why it's such a smart strategy for folks who are probably between 55 to 80 who don't mind spending 3 to 5 minutes 3 times a week to generate retirement income for the rest of your life. So number one, we like the SPY ETF because it's the only security in the world that has expirations every Monday, Wednesday, Friday. And you'll see this gives us the ability to protect our capital in a way that's just not possible with any other stocks. Number one, because it has so many options, expirations, we can constantly protect our position. So that's number one. Number two, we can make a lot more option premium than we could with a normal stock or ETF. They only offer weekly or monthly options on every other security in the world. So if you kind of thought of this as a nice apartment in a big New York skyscraper, and you're using the Airbnb app to constantly book it out for expensive per day rates, that's what this is. We're getting the top premium possible in a very premium apartment, but we don't have to worry about the value of We don't have to worry about fixing things in the apartment. We don't have to worry about a slow season where no one's going to rent. One sec, guys. Let me. So what we have is a very hands-free way to essentially let bull market speculators gamble on how far up the stock market's going to go in a few days. So this is a defensive trade. We saw the TLT and the SPY go up at the same time, which is abnormal. And so I believe that there is a correction coming where the rates will go up slightly and the stocks will go down slightly. And so you can see I wrote the strike at 286 while the trading price was at 288.09, and that was on Monday. So what does a covered call mean? It means we're willing to sell our shares for whatever the strike price is. And in this case, I'm agreeing to sell my shares for less money than they're worth at the time of writing the covered call. So why would I do that? Well, it's because the option gambler paid $2.41. So if I'm wrong and he's right, he might make a quick 50 to 100% return. And I'll get to keep the difference, which in this case was about 30, or let's see, which was about 31 cents, so $31 per contract. Now, if he's wrong and the market goes flat or down, he's going to lose most of his money, and we get to keep our shares of the ETF. So that's the name of the game. And we were right. The market did go down a little bit, and this made the value of the option contract decrease. So while we collected $2.41, we were able to buy it back for $1.47. Now, if we had done nothing and just let this go into expiration, we might have made a little bit more money today. But we wanted to continue collecting option premiums, so we wrote another one at the same strike with a very similar setup, collecting $2.04. So if we look at the net result of the trade, on the covered call, we had a 94-cent profit per share. So every covered call represents 100 shares. So that's $94 of profit realized on the covered call. Now, if we look at an unrealized loss in the underlying ETF, the SPY ETF did lose 75 cents of value during that period. Now, again, we have a very long-term outlook. We're going to be renting out this room forever until we're done with it and pass it on to someone else in our family. And so while we're not necessarily worried about that, we can look that even though we did create a $94 profit per contract we wrote, our underlying asset did go down in value slightly. So the profit net at that single moment in time was $19. So if you did just that, 19 bucks, and normally we're doing something that's aiming for closer to 100 bucks. But right now we're very cautious because a few things just aren't adding up. But if we could pull $19 per contract and do that 156 times a year, that's $2,964 of income, or over a 10% return from a very, very safe trade that can be done over and over again. Now, the reason we do want to cover the position and take a little less, we had about 31 bucks we could have made. However, when the stock goes down, what's called implied volatility goes up. And what that means is as the stocks are going down, the premium we can collect selling our call options goes up relative to the distance of the strike. So it's actually very good for us. When the stock market gets nasty and starts jumping up and down, the prices speculators have to pay to buy these options goes up. So the new trade is very similar to Monday's trade. The last trading price was 287.43. We sold it the 286. So we're taking in a loss of $1.43 at this very moment of writing this, but we're collecting 204. So that is, again, a 59-cent baked into the cake profit if we're wrong. If the speculator is right and the stock jumps higher between now and Friday, we make the baked in the cake $59. And that adds up to about, let's see. So a $59 credit 3 times a week, that's $9,204 of income per 100 shares of SPY you own. Now, how do we get up towards that $100 mark? Let's take a look at an option chain. So to get towards the $100 mark, we're going to have to be writing a covered call that is either at the money or a little bit above the money. So if we chose perhaps this one, we're now agreeing to only sell our stock for $288.50, which is more than it's worth right now. So in this case, we can actually show profits in our underlying asset and in the covered call in the same 48-hour period. Someone buying this call option is very bullish and very greedy. They think the SPY is going to jump up above 280.50 plus whatever they paid for that option. So they're thinking between now and Friday, the SPY is going to trade to 289.12 just to break even. So they're expecting to really fly high if they're buying that call option. So oftentimes we can collect the entire covered call or most of it and let our underlying asset appreciate by writing a strike that's slightly above the trading price. So that's kind of the way we defend our capital. If we're worried about downturn, we simply write the covered call lower than the trading price. So let's see just how much protection could we have between now and Friday if we thought something really bad was going to happen in just a 48-hour period. Okay, so we're looking at an option chain for the SPY that expires this Friday. And so the question is, how far can we go before we lose money and we're not in a risk-free situation to basically bet the market will go flat or down? And so right now, the current trading price, sorry about the wind, guys. We're having some crazy wind today. So right now we're trading at 287.85. And if we went all the way down to, let's say, 283, let's try this one. So this would protect us for about $5 of movement in the SPY between now and Friday. And let's look at what we're agreeing to do with this covered call. So we're agreeing to sell our shares for $283 a share. But right now they're worth $287.83. So we're essentially agreeing to a $4.84 loss right off the bat. So why would we do that? Because the option buyer is giving us $5. So that spread is our baked into the cake profit. So we actually could make money if we had this much protection between now and Friday and we're wrong. If we're wrong, stocks go higher, we get assigned, we have a baked into the cake profit. But what if we're right everyone else could be showing huge losses for every 100 shares that they owned of the SPY ETF. They could be losing $500. Whereas we have that completely protected and earn our same boring option premium profit. So that's basically how simple it is to be able to generate income and protect your capital. And there's no easy way to do this outside of owning the asset and writing an in-the-money covered call. Now, do we have other defense mechanisms to protect our capital if the market does start to get nasty? Yes. And this seems to be the biggest fear for most people coming into the program. So let's take a look at some of our other options. Okay, so we're looking at the portfolio spreadsheet. This is a $500,000 portfolio. You don't need $500,000 to follow the program. You really just need 30,000, so you can buy 100 shares of the SPY and have a little cash on the side for what I call the hedge. So what are the hedges we might put into our portfolio if things did get turbulent? We have two lines of defense up front, and also potentially a third option, which may be a good, one sec. So the most correlated product to the S&P 500 is the VIX, or rather the opposite correlation. And so if we believe that the SPY ETF has a period of turbulence for about 3 months, our best bet will be to buy a call option on the VIX. So let's take a look at the VIX. Most of the time, the VIX is traveling lower or flat. And there's just very few times in history where we get these tremendous crashes that push the VIX really high. And so we can see one in 2008, one in 2010, one in 2011, really nothing between 2012 and 2014. Little scared in 2015. We had a kind of a double crash in 2015, followed by more and more QE. And then the last several years have been relatively muted, only jumping up to about 25. So this is one way we can get leverage by purchasing a call option on the VIX, but it has some downsides to it. The farthest out we can go on the VIX is September 18th. What you need to remember about going on a VIX call options, we actually want to sell it halfway through. So this expires in 161 days. So that would really only give us about 80 days of protection in our underlying asset. The other thing is that every day we're wrong and the VIX does not jump, this quickly loses value. So you can see why it's a lot smarter to protect from downside with the in-the-money covered call and generate the same boring income that we're making 3 times a week than it is to go buy a risky VIX call option. So for folks who are wondering when and if we would buy the VIX, it'll be after we see the market weaken. So we're talking about a dramatic sell-off that is very fast. And most likely during that period, the stock might travel slightly lower than our strike was written in our covered call. So that is going to be a 9% portfolio position, and it will be very, very careful for us to alert to put this on. So this gives us 3 months of protection. The next easy trade that can help protect our portfolio is a 1% position in the QQQ puts. Now this we can buy protection out to 2021 for 646 days, but again it really only provides very good value for half of its time frame. So we'd be trying to sell this by the same time next year. Now, this would actually be something I'd only recommend if the fundamentals have dramatically changed. Either we are going to war with China and raising tariffs, or the central bank is in the mindset that inflation's a problem and they're raising rates. So those are the only two outcomes right now where I would say let's put on this QQQ out of the money put option. And so when we layer those on top of our covered call strategy, we have a lot of protection. And this will be probably the one place, one of the few places you can find to make a consistent return in any market condition. If the market's going up, sure, you're going to have that fear of missing out. We made less than everybody else. Boo-hoo. But if the market's flat or going down, we're making even better returns and are protected. So that's just the very easy, simple way this product can defend itself against downturn, but still not lose money if the market goes up. So I know that's been a big question for a lot of folks. Let me pull up our track record and do a quick review of where these trades all plop in. So this is our current open covered call. You don't have to use a spreadsheet. I know a lot of people throw up in their mouth the second they see a spreadsheet. So really all you need to know is how many multiples of 100 SPY shares do I own? As far as covering your position, you don't even need my alert. You know, Monday, Wednesday, Friday, cover it at whatever the market price is. That's usually one click in your broker. Now we got to write the new one. All you need to know is expiration date and the strike. So it's very, very, very simple, very repetitive. If you want to use a spreadsheet, then we have a very pretty and color-coded, I call it it's just a glorified calculator. That's all this thing is. It's a very glorified calculator, and it can keep you straight if you like it. Everyone in our program has their own copy of the spreadsheet to keep track of what you're doing. But I know a lot of you guys don't like spreadsheets. So how hard is this? You need to know how many 100 shares of the SPY I own, and then that's all you got to do. Write the covered call. The next Wednesday, buy it back. Write a new covered call. The next Friday, buy it back. And it repeats over and over and over again. So the result is that we have a small return that compounds 156 times a year. The con to our strategy is that you may miss out on tremendous growth if the SPY is about to go into some sort of market melt up for the next few years, which is certainly possible. I stand by that the market's a random walk and no one can predict it. We let the option market give us a good idea, and that has done very well for us, but we're going to make about the same profit no matter what's happening in the market. So growth strategies may outperform us 10, 20, 30 years from now, but most of the people following this product aren't worried about growth. They're now worried about protecting capital and making a predictable income for the rest of their life while being able to have a great asset to pass on to their kids. So if that's what you're looking for, this is a great product to do it. And again, because we're collecting a small profit over and over and over and over again, giving away your money to a broker dealer is just stupid. You might as well sign up for Robinhood, where you have absolutely no commissions. If you use the link in our email, there is a free stock they give you when you sign up, and they also reimburse our company by giving us a free stock too. So just a fun freebie. These guys have so much money from private equity that they're basically just giving away everything. So it's something you should take advantage of. Now, a quick review of some of our other products. This again is our basic product. It's for total newbies. It provides a lot of value in terms of safety of capital. It's a little time consuming. You do have to do a 3-minute trade Monday, Wednesday, Friday, but it's not a lot of work. And for those of you who don't have $30,000 to get started, we offer a second strategy in this basic program, and that is trading the TBT, which is betting that rates will rise slowly over time. And so this one only costs about $3,300 to get started. You need 100 shares of the TBT. And I actually recommend that if you are not spending the profits that you're compounding from our boring SPY trade, if you're not using all that cash that's coming in because you didn't need all of it, where should you sit your money? Well, this is where I would sit my own money, is the TBT ETF. So as you find yourself in a position where you can afford 100 shares of the SPY, but you can't quite afford 200, put all that extra capital into the TBT trade. And this one is performing very well and has a great outlook. Just the simple math, the US government is spending more money than it makes, and eventually the cost of money is going to rise. So until we get a hold of our deficit, it's just ludicrous to think that the US government can continue to borrow and borrow and borrow for free for a very long period of time. And so that's as simple as it is for understanding the TBT. Great ETF, and it's doing the same thing. Now the TBT only trades on Fridays, so I'm only going to be going over the trades for the TBT on the Friday. We had been publishing it on the Monday, Wednesday, and it was a little confusing for folks. So if you want to get started on the TBT trade, that will be Friday's alert, and it will also be in tandem with the SPY. So again, just to beat this down, this is a very easy program. There's no magic to it. It's about as boring as watching grass grow or paint dry. Its best selling point is that we can protect your capital very quickly. Monday, Wednesday, Friday, if the SPY is trading lower, we write the strike much farther and farther below the trading price. Market's moving higher, we're going to be writing the strike price above. So it's pretty simple. We make more money when the market's going up and we're writing the strike price above. So that's the most ideal situation. In those cases, we might make between around $100 3 times a week. So that really adds up. That's $15,600 of income when we're writing the more aggressive trade. And even when we're playing it safe, like this trade, we're still looking at a $3,000 yearly income playing it super safe, which is still over a 10% return. So it's just really hard to beat the returns on this with the safety. Plus, the SPY is the most highly traded stock in the world. There's nothing else even close to it. Plus, it represents a fund that has the top 500 companies in America. So you're not betting all your money on a single corporation that might have some serious trouble ahead that you didn't see. You have your money spread out between 500 companies, and the largest position is 5%. The biggest position in the SPY is only 5%. So you have diversity in terms of owning American companies, as good as it gets with the SPY. So there, in my opinion, it's the best product in the world, hands down. And when you add in the 3 covered calls, it really adds up. So what else do we have to offer clients? We have the high yield covered call strategy. It's the same thing as the SPY, but we're removing the cushion of the ETF. So the ETF obviously has to make money, otherwise why would it exist? And so they make money in a lot of ways. But if we look at what's under the hood of the SPY, we got a question. How many people on the call today? 10 people. We've been having about 10 all week, so good crowd. And in a minute, we'll open it up to Q&A. And I want to introduce you guys to 2 of our support team members, John and Mike. So I'll do that in a minute. So on Tuesdays, we have a little more advanced class. We're looking at what's under the hood of the SPY. If you look at what's under the hood and you remove the companies that are just too expensive for most retirees to own, like Amazon, Google, and Berkshire. We end up with this portfolio with this target allocation size. And a big thing today on the House hearing with the bank CEOs is they're going off about how the government bails out the too big to fail banks. It's no wonder Warren Buffett has almost half of his entire stock portfolio loaded up on Apple, Bank of America, and Wells Fargo. He knows, just as well as everyone else does, the banks are the first companies to get bailed out by the government. So it's a very safe place to follow our program. And we have 30% of the portfolio in the banks. And if I thought we were really going into a downturn, I would zero out all of these, Microsoft through Comcast, and probably be all in on the banks and put a position in the short high yield SJB. So we have the ability, by changing these settings up top, to easily reallocate capital to the right area. So we might go something like 20% cash because we'd be playing the VIX, the QQQ. Maybe we go 60 bank, and then we go put 20 into the short high yields. What's the short high yield? What would this do? So now you can see it's telling me to sell these shares. And based on the capital in this portfolio, it's telling me to purchase more of Bank of America, Wells Fargo, and to buy this SJB ETF. So this is a cool feature in the product. Now again, you can watch me from the spreadsheet doing this and just say, oh, okay, I know how much money I have. I can multiply by 100. This isn't rocket scientist. So, for those of you who don't like spreadsheets, don't freak out. It's just, this is how all pro traders do it. And we've simplified it for you so that this is very, very easy to follow. So this is our high yield class. This is on Tuesdays. This is our diamond level membership. It also comes with our cryptocurrency software, which is just recently, this is a good example of why you can't be a swing trader, day trader kind of guy. People have been trying to guess when Bitcoin was going to turn around for months, and it's almost comical. They're sitting there trying to, it's like predicting the weather. Let's look at what you had to do to actually capture this Bitcoin profit. So you can see it was bouncing around 3,500, 3,600. I listen to this guy, Josh, what is this, Telegram? They're looking at technical analysis, MACD, all kinds of crap. But did a single one of them predict that it would jump from 4,000 to 5,000 on April 1st of all days in a single trading day? Of course not. So this portfolio went from showing a loss to overnight jumping to a 34% profit. It was sitting on a 25% loss since we created it, really, for months. And then overnight, the profits are just skyrocketing. And that's the way it is. Things don't do anything for a long time, and then overnight, the market changes and you miss out. And now everybody who's sitting on their hands is wondering, is it too late? Is it going to go down? And so these are the sort of questions that hold people back. So let's go back to this portfolio. You can see it's outperforming the SPY trade, and that's because by removing the SPY ETF, we get a higher payout on our covered calls. There's more risk in a single company than there is in a basket of 500. So that's how that works. Now look, the SPY has a 5% position in Microsoft. We have a 23. So we have a concentration of the best companies in the SPY, QQQ, and Berkshire Hathaway, which is also a top position in the SPY. And by doing so, we can now aim our strike at a per security level and generate a higher yield. It's about double. Now you do need more capital to follow this program. This allocation costs $150,000 to build. but it's a great group of stocks. These are really the cream of the crop. So that's a review of that. In terms of cryptocurrency, we're talking 5 to 10% portfolio exposure max. So if your position has jumped up in value, it all of a sudden represents 11 or 12% of your portfolio, probably a good time to cut it back down to 5%. And on the other hand, if it drops from 5% down to 2.5%, it's a good time to buy. It's time to load up. So that's the general recommendation we use. And our software basically builds the SPY ETF of cryptocurrencies. So I'm not going to get into a ton of detail on how that works on this class. If you do want to learn more about that, next Tuesday will be when we cover it in detail. But it's the same idea. We're trying to diversify our risk. We're looking at the trading volume. So if you thought, a stock's valuation is based on how much profit it generates, well, a cryptocurrency, you might think, how much of the cryptocurrency is being used? What's its trading volume? And while there is fake trading volume out there, we have some good methods to basically filter through that and get a good idea of what's the real, true trading volume of these different currencies. So, okay, that's the Tuesday class. The other class we have says, all right, well, what if America's slowing down? What if after World War I and World War II, we had a huge lead around the world? They had all blown themselves to pieces and given us all their gold while we're sitting in this big island protected with the ocean as our wall. And we had a huge advantage for about 100 years now. So what's the story moving forward? Well, the story moving forward is that China and India are growing much faster than us, way faster. And so there's good reason to start looking at taking some of your capital and pushing it abroad. And so the second highest traded ETF in the world is the EEM Emerging Markets ETF. And if you look under the hood at what it actually buys, you'll see it is purchasing securities in these 5 countries primarily. And so this is the allocation breakdown of that. And also what we have here is the precious metals, gold and silver. And then we have a hot company called Tencent. Tencent has purchased something like 16 tech companies that are now called unicorns, which is $1 billion company. So they are one of the fastest growing companies, and they've bought out 2 products either I use or my son uses, which is the game Fortnite. I'm sure everybody has had to hear about Fortnite and seen all those silly dances. And the game we like to play here in the office during our break is called Clash Royale. Clash Royale has had this huge idea to give away the product for free, and if they like it, they can start buying like their own cryptocurrency. They call it gems. So that company is making insane amounts of money as well. 2 of the most popular games in the world. So this is a good way to take maybe up to 25% of your portfolio and do the same thing. We're going to protect the capital with the covered call, and we're going to get a little bit higher yield, and we're diversifying our risk out of America. So this portfolio is doing well and trades every Thursday. Now, sorry about the wind, guys. We're having some crazy wind today. So that's a good wrap up. Let's take a quick look at a few other charts. Dollars remaining strong. If you follow Jeffrey Gundlach, let's see. Oh, Mike says Tencent has a strong green candle. Nice. That's always good. We like charts going up. Okay, so Jeffrey Gundlach, big prediction, also with Ray Dalio, is that the dollar is headed for trouble due to the debt levels of the government. Amongst other debt levels, really everything, corporate and consumer, high levels of debt. So that's something we watch carefully. If the dollar gets weak, the reason to purchase emerging markets will rise. So if the dollar starts to get weak, we may recommend a higher and higher allocation over to this portfolio. Here's the chart that everybody should study. Federal funds rate. And I actually found one that goes back a few hundred years, which was interesting, all the way back to the first bank in America. So a big prediction is that this chart is going to repeat itself just backwards. So right now we're printing money and we're not seeing inflation. They think they can keep doing this forever. But if you look down the road, it looks like inflation is slowly creeping in, and perhaps we will see these rates have to rise. And so that's a big prediction. That's where our TBT does very well. But right now rates are low. Inflation, we like to keep an eye on inflation. I do want to point out the dot-com bubble crashed with very low inflation leading into it. So I think these prints are actually the exact same as this year. So 1.7, 1.6. Oh, it's a little lower this year. So inflation seems to be the magic word that will cause central banks to raise rates. So that's that. Another chart I like to show is the Dow over all years. And so right after World War I, World War II, we had a period where there's a lot of federal spending. And this eventually led to inflation. So we're actually having the same conversations that came out of post-World War II that we're having right now. It's remarkable how similar the same problems and the same solutions are being presented to us. So, you know, what I ask you is, what if we're somewhere in here, 1964? You know, we're in the middle of this crazy bull market that just goes straight up. And little did you know that even though everything seemed perfect and amazing in 1964, if you bought at the top and we're not following our strategy, you might have to wait until 1994 to get back to even. That's crazy. Can you afford 30 years of no income, of losses to your portfolio? So the answer is no. So while we may look like a fool, you know, missing out on the profits of this crazy bull run, who's going to look like the fool when there's a decade of having to work down this insane debt load that America's piled on? It's not just America. The entire world has been piling on this debt. So when you look at this chart, you look at the 60s through the 90s, that's when you realize you need to have a strategy like ours to protect your capital and generate the same boring return over and over again. So I don't know what other strategies people have out there, but you know, how do you get a risk-free way to generate income and protect your capital? And that's what we've delivered with this program. The other thing I like to watch is the yield curve. And so we have this bizarre, you can get paid more to buy the short-term debt from the government right now than you can the 2-year, 3-year, 5-year. So this is freaking people out. Every time the yield curve inverts, it's usually a signal that recession is ahead. But the good news is it's usually, you know, 12 to 18 months away. And quite often, leading into a big crash or depression or recession, we get a melt up in assets. So that's something we're definitely aware of. I don't want to miss out on a melt up, certainly, and we'll definitely be carefully watching this. Now, our TBT is directly related to this 20-year. So another signal of problem ahead is a steepening yield curve. So first it inverts, and then it steepens. So if we are headed towards a potential recession, this 20-year yield should steepen, which will make the TBT go up much higher. So that's what we got going on there. And I think that's a pretty good overview of our program. I'm going to go ahead and open it up. Let me first introduce John and Mike, see if they're around. John, Mike, you guys out there?
Yeah, I'm here. This is Mike.
Okay, so I call it John, the 30 years in the business and finance. He can give himself an intro. And Mike is the ex-doctor. These are two folks that work with us who can answer your questions. I know sometimes you got to be a little skeptical of whoever's selling the products. So now you can talk to someone who's been around for a long time. Mike's actually followed our program for about 2 years now. And so that's how he actually was found in the first place. Let me pull up their phone numbers so that you guys have that. Why don't you guys introduce yourself, tell them a little bit about your background.
Mike, you want to go first?
You can go first, John. It's okay.
Okay, yeah, my name's John, and I've been with Jason now for a few weeks. I do have several years. I'm not sure I want to tell you how many years. It might give away my age, but I definitely have a lot of years in the marketplace, both in the credit market and the equity market. As you know, the credit market is about twice as large as the equity market. It covers all of the bonds that are essentially issued. But, the one thing that I think impresses me more than anything about Portfolio Builder and Jason is if you know anything about Wall Street, the real premium on Wall Street is information. And information is important because the professionals out there that pour over information voluminous every day are looking for one thing. They're looking for what they consider to be a viable interpretation of that information. Once they have it, then they can take an action, usually a buy or a sell or even a hold. But it's information that will help them make what they consider to be valuable fiduciary decisions, whether it's for their own money or whether it's for clients' money. And why is that important? Well, it's important because if you understand what that system is, institutional clients and even high-profile retail investors, they will pay tens of thousands of dollars for such a service. In some cases, hundreds of thousands of dollars for such a service on a yearly basis. Why? Because it does one of two things. It helps them increase their profits or protect their losses. Now, when you consider what Jason and Portfolio Builder is doing, even at the lowest level, which is the basic level, TBT and the basic SPY strategies, Jason is pouring over information every day. He pours over a lot more information than I'm willing to even look at to come up with an interpretation and to provide you with an action that you can take in your portfolio to either protect your profits, increase your profits, or both. And what can he do that for? Not tens of thousands, certainly not hundreds of thousands, $900 a year. If you really think about that, that's less than $75 a month, which is less than $2.50 a day. Now, if your portfolio or structure of your portfolio is more than 100,000, and probably it is when you consider the equity you have in your home, the qualified accounts you have, which are company retirement plans, Roth IRAs, individual IRAs. When you consider your financial structure, ask yourself this question. If you haven't already come aboard, ask yourself this question. Is all the money that I've worked hard to make worth $2.50 a day to protect, to grow? And if you answer that question honestly, I think you'll come out with a good decision. You will have taken the information, you will have interpreted, and you'll move into an action. You'll either come aboard or you won't. But that's really what you're hearing when you listen to Jason talk about everything that he's talking about on these webinars. So listen, I've spoke a lot here. I want to be quiet now and give Mike a chance to talk. But hey, thanks for introducing me, Jason. I appreciate it.
Oh, very good. Thanks, John.
So, hi, everybody. I'm Mike, and I totally agree with everything that John's saying. He has a great way of relating it. Yeah, I've known Jason for quite a while now, and I can honestly tell you, both as a client and now working with him, that he's very transparent. He pours, just like John was saying, he pours through the financials every day to do his very, very best to give you information. And what more can I say? I am a retired doctor. About 6 years ago, I retired, And I always had an interest in finance, and so since I retired from medicine, I just started educating myself on the markets, options, etc. And since I met Jason, I've learned an incredible amount of information. And this program is extremely legitimate, and I highly recommend it. Like I said, both personally as a client and as an employee. So
Excellent. Well, thanks, guys. Let me open it up and see if anybody has any questions out there. We've got a mixed bag of folks who are on their free trial and folks who are already paid. So, Paul, you just joined yesterday. Thanks. I think you were speaking to Mike. Robert's a new member. We got two Jerrys out there today, Henry, and a new guy, Investor714. When did this start? Oh, the webinar? It started an hour ago, so there will be a replay. Let me show you guys where we keep all the replays so that you can always, we're going to try to get more exposure to the webinar recordings too, because it's a lot of good info. But if you go to portfoliobuilder.io/webinars, we constantly update the most recent webinar onto this page for each of our three products. The basic program, which trades Monday, Wednesday, Friday. The gold membership, which does emerging markets on Thursday. And then the diamond level membership, which only trades on Tuesday. So if anybody does want to, now if you call in, you can save from the listed price on the website. Again, this is a very hands-on business. We want you to talk to somebody and have that support structure behind you. Let's see, what other questions we got out there today? Now we got Jerry Simone is just a show off. He's been outperforming our portfolio using the platform. Let me pull up your spreadsheet again. That's always fun. Now, every time I do pull up a spreadsheet, I throw out the disclaimer. These results are not average, and he did not even follow our trade alerts. Perhaps he followed the ideas and put it to work. And then, Ryan, can you send me the portfolio at password? Can you send me the portfolio at portfolio builder password real quick?
You need my email address at all again, Jason?
Yeah, post it for me if you don't mind. I'll pull up yours.
Sure.
Now, I wanted to have okay, so we hadn't quite finished moving all your trades over yet, huh? Oh yeah, I got to move your covered calls. So Jerry's showing how we can take the idea of this product. Okay, we got another problem. Do you have the trades archived and are we able to access it? Yeah. Yes, if you want to see all the history of trades. You can always go to portfoliobuilder.io/the latest. And this it does delay it, so people aren't, cheating our company out of the trades, but everything's published here. Also, every email has a link to the track record. So of course, that's where all the trades are as well. So we have really 4 portfolios. We have the 2 representing the basic. This one's just trading the SPY primarily, while this one's trading the TBT, although it's easy to combine them into a single portfolio just by putting a little 10% on right here. Well, let's look at this one. If you want to do the SPY and the TBT, which I do recommend, you might drop this to 80 and this to 10. And that'll help you have some cash to be purchasing lots of 100 TBT shares in between getting enough capital to buy your next 100 lots of the SPY. So all the trades are also here. Let's look at Jerry's spreadsheet. So we're in the middle of fixing it up. But what he did was, let's see. Yeah, we still got to fix this up, huh, Jerry? I'll demo this tomorrow after I fix it up. But essentially, he switched out some of the tickers and was sitting on, what was your profit yesterday? It was like $7,000 or something.
Yeah.
Yeah, so he's doing very well, doing the same idea. Just switched out a few tickers and kind of combined all three programs into one spreadsheet. So we're going to help him spread it out so that the VIX, the VXXB replaces the SPY. He still has a TBT, so that'll all be managed in his basic. We're pushing his emerging market and gold exposure into that tab, which will correlate with our Thursday trades. And then he does want to have some exposure to some of the high yield stocks. And so we'll keep that organized on the high yield tab. And so we did this live in a webinar as I took his positions and started rebuilding it out. And unfortunately, it did break some of the code that's programmed into our platform. So I'm gonna go ahead and reissue you a fresh spreadsheet and post all your trades into it, and we'll bring it up tomorrow. I'll make sure to get that done this evening, okay? Because it does make for a very good tutorial as to how you can slightly adapt our strategy and our platform to get even better results.
Yeah, it has that emerging market too.
Yeah. So you got emerging markets right here with your gold. You're basically replacing the SPY with the VXXB, which are a similar correlation, at least one that you can easily, you can look at what I'm doing with the SPY and figure out what to do with your VXXB, and then getting you some exposure to the bank, Microsoft, and Apple. So the codes got a little broke when we were fooling around with it the other day, and I think you were also deleting some rows and adding rows that may have affected it. So I'll fix it up for you for tomorrow's webinar.
Okay, cool.
Let's see, any other questions out there, guys? No question is dumb. I want to make sure everybody knows, you know, we don't laugh at people. If you have a question, throw it out there. Most likely, if you're thinking it, someone else is thinking it as well. Although this is our core group, so I think we've all ran out of the same questions here. All right, gentlemen. Well, it's been another great webinar with you, and I hope to see most of you tomorrow on the emerging markets class, and we'll go from there.
Thanks, Jason.
Yeah, my pleasure.